Welcome to this explainer. Listen, I want you to start by just sitting with a really strange, kind of quiet paradox that is currently unfolding right now at the absolute highest levels of global finance. As we speak, the central banks of the world are quietly buying up an asset that pays zero interest, earns zero dividend, and literally does nothing but sit in a heavily guarded vault. Yeah, we're talking about gold. And the country that should understand why this is happening better than anyone alive is actually the one that got the question wrong first. So today we're diving deep into the two-ledger argument. We're going to see why the dollar's greatest privilege is quietly dismantling the country beneath it, and why the institutions that control our money are behaving exactly the way they are. Let's get into it. To give you a sense of scale, we are talking about more than 1,000 tons of gold purchased per year for 3 years running, from 2022 right through 2024, and they've bought hundreds of tons more since then. This is not just some minor portfolio tweak by a cautious manager. This is a massive, historic accumulation. The pace at which these massive institutions are moving is honestly staggering. They are hoarding a non-yielding asset. Now, we're constantly told on the news that gold's rise is all about debt, or deficits, or inflation. And sure, those things are true, but they describe the fever, not the underlying disease. So we really have to ask ourselves, why on earth are central banks trading paper that they can easily print for a metal that they absolutely cannot? Why are the people closest to the actual machinery of money abandoning their own promises at the margin for an asset that is literally nobody's promise? Look, if you want to understand this as a serious structural shift and not just a nervous market reflex, you need a mechanism. You really need to understand what exactly is breaking down.
Part 1. The two-ledger argument. To make sense of this, we're turning to Craig Tindale. Now, he's not an academic economist or a central banker. He's an Australian investor and systems engineer. He looks at economies from the outside in. And actually, that outsider's eye is exactly why he can see the machine that trained economists keep missing. Normally, we look at reserve currency status as this exorbitant privilege, right? It's the incredible superpower to borrow the world's savings cheaply, run massive deficits, and buy real, tangible goods with paper that only you have the power to issue. But Tyndale's argument completely flips this on its head. He says this privilege isn't just abused, it is entirely self-cannibalizing. The very thing that makes a currency dominant is the exact thing that hollows out the country underneath it, because suddenly shuffling paper around becomes vastly more profitable than actually building things. So here is Tyndale's core concept. Every single country runs on two ledgers. On one side, you have the financial ledger. This is your asset prices, your credit, property, and paper claims just stacked on top of paper claims. It expands effortlessly, and you can inflate it almost without limit. But on the other side is the material ledger. These are your factories, your power grids, refineries, and the actual physical skilled hands of the people who know how to run them. That ledger is brutally slow to build and incredibly easy to lose. A healthy economy uses the financial ledger to fund the material one. But the trap snaps shut when that link gets severed, when the financial side swells up like a balloon while the physical side quietly shrinks. Which brings us to a phrase you absolutely need to know: conversion capacity. This is ultimately what gets lost in a highly financialized economy. It's the machine tools, the energy systems, the supplier networks, the physical ability to turn money into real, tangible output. True sovereignty relies on this physical capacity, not just having a strong national balance sheet. When a financially powerful country suddenly collides with a materially constrained world, it wakes up to a terrifying reality. A broken supply chain or a missing factory cannot be instantly fixed with a giant checkbook. You just can't quickly buy back the physical capacity you spent decades letting rot. Part 2. Britain's cautionary tale. The crazy thing is, we don't actually have to guess how this story ends, because Britain has already run this entire loop from top to bottom. If the United States is currently living through the movie, Britain has already seen the end credits. Sterling was once the dollar of its age. Back in 1900, the pound made up about 60% of the world's reserves, and today, it's sitting at just about 5%. This is the self-cannibalizing privilege carried out to its ultimate conclusion. Britain's share of global reserves is 5%, but its share of world output is only about 3%. Think about that. It's a financial role that is still larger than the real economy backing it. Meanwhile, British manufacturing plummeted from 30% of the economy in 1970 to under 10% today. The material ledger didn't just shrink, it totally inverted. And here's the kicker. A services-based economy alone simply cannot balance the books. If we look at Britain's data for the last quarter of 2025, we see a massive deficit in goods. We're talking around £65 billion. Now, this is partially offset by a services surplus of about £53 billion, mostly driven by the City of London's banking and consultancy sectors. You guys, it is Tyndall's two ledgers written straight into the national accounts. The City of London is the financial ledger, and the empty factories are the material ledger. The financial ledger simply cannot balance the material deficit. Now, you might be thinking, okay, so you lose reserve status. What's the big deal? Well, losing it doesn't mean you avoid the reckoning. In fact, it just rips away your safety net. When you are the reserve issuer, you can hide the damage for decades because the rest of the world is basically obligated to hold your paper. But the second you lose that status, the market disciplines you violently and quickly. Just look at Britain's timeline of crises. You've got the 1976 IMF bailout, Black Wednesday in 1992, and the 2022 pension crisis, where funding markets literally seized up in days. Reserve status only postpones the trap. It doesn't prevent it. Part 3. This services illusion. Right, so mainstream economics will usually argue that an advanced nation doesn't actually need to manufacture physical things anymore. They always point to this widely accepted theory of comparative advantage. The idea is super simple. Export the dull, low-value production to where labor is cheap, keep the high-value software and design work at home, and just import whatever you need. Sounds great, right? Perfect harmony. But watch what that argument quietly assumes. It completely assumes a peaceful, open world where you can always buy exactly what you need. It's a theory built strictly for peacetime. Furthermore, it completely ignores a basic truth. Innovation lives near production. If you let the manufacturing leave, eventually the design and engineering will follow right behind it, because you can't improve what you're no longer build. And let's look at the brutal arithmetic proving that world-class services simply can't pay the bill. America possesses the absolute best services surplus in the world, running at roughly $300 billion. That's huge. But look at the goods deficit. It is over $1.2 trillion. The win in services doesn't even come close to covering the loss in goods. I mean, it's practically a rounding error against that massive gap. To pay for what it no longer makes, the economy literally has to sell off assets and issue debt to foreigners year after year. Services don't avoid the trap. They literally fund it. Part 4. Money that is matter. So a sharp critic might jump in here and ask, okay, if physical production is the problem, why are central banks buying gold instead of, say, copper or uranium? And that brings us to a really powerful metaphor. Fiat currencies are the players. They are the competing promises of different nations. But gold is the referee. In a unipolar world, you can easily settle accounts in the dominant player's currency because trust is cheap. But we are rapidly entering a multipolar world where rivals don't trust each other and absolutely won't hold each other's paper. When no one's promise is good enough, you need an asset that is nobody's promise. You need a neutral referee to settle the accounts. And there is this painfully ironic historical moment that just perfectly illustrates this. Between 1999 and 2002, the British Treasury sold off around half of the nation's gold, nearly 400 tons. They sold it at rock-bottom prices, averaging roughly $275 an ounce, right before the multipolar era really kicked off. It infamously became known as Brown's Bottom. Fast forward to today, and gold trades near $1,500 an ounce. The gold they basically gave away for $3.5 billion would be worth well over $50 billion today. But honestly, forget the massive pile of lost money for a second. Focus on the sheer folly of the decision. As the source brilliantly puts it, they sold the referee to buy more of the players. I mean, wow, that just hits the nail on the head. A completely financialized establishment looked at the one asset that is both money and matter, decided it was a useless relic just because it yielded no interest, and traded it away for paper claims. This is the mind of the trap, captured perfectly in a single devastating act of policy. So what is the big takeaway for us here? You absolutely must understand that gold is not a bet on growth. You buy copper, energy, or uranium for the upside of rebuilding the world. Gold is completely different. Gold is a reserve. It's insurance against paper in a fracturing world. It's the fundamental position you take when trust in paper begins to break down. They are two entirely different trades, and they really do not belong in the same mental account. Which leaves us with this final question I want you to ponder. Are you just reacting to the daily noise of crazy financial headlines, or are you truly grasping the structure of this slow divorce between money and matter? Central banks aren't hoarding gold purely out of panic or fear. They're doing it out of memory. They know exactly what happens when the financial ledger outruns the material one. Understand the structure, recognize the trap, and really ask yourself, when trust in the players is finally gone, do you hold the referee? Thanks so much for joining me on this explainer, and remember to keep questioning the structure of the world around you. Catch you next time.